Whether that's getting too far too fast, something I'll raise with California Republican Congressman Devin Nunes, a member, of course, of that crucial House Ways and Means Committee. Sir, very good to have you.
Great to be here, Neil.
All right, I talked to Chairman Kevin Brady. He was very optimistic that an aggressive, sweeping, comprehensive tax reform package is in the works, that you guys are largely, I don't want to misquote him, sir, on the same page when it comes to making sure it's big. But is it doable? I mean, what is it the kind of thing that's going to be combined together? Corporate reform, individual rate changes? What do you think?
So while most people weren't paying attention last year, House Republicans were busy drafting a blueprint. Everyone thought that Hillary Clinton was going to become the president. People thought for sure the Republicans were going to lose control of the Senate. And we actually have been working not only last year on a blueprint, but we've actually go back 8 years looking at all different ways on how to do tax reform. And I would say actually that this, you talked about the 1986 Reform Act, Neil. This is actually bigger than the 86 Reform Act. This is actually fundamentally changing the code. It's creating fairness across the system. So we're actually doing away with all the confusing rules, accrual accounting, cash accounting. We're going to a cash flow system. And it's a system that every American will be able to understand. And if Donald Trump is in fact going to make America great again, he's going to do it with the blueprint that we put out last year. Republican House of Representatives.
So is it your blueprint, Congressman, that's leading the way? In other words, he likes what you guys are crafting and pretty much wants to echo that?
Yeah, we like that Donald Trump, President Trump, during the campaign went big, and he challenged us to get to 15%. And really what we're doing, coming in at 20%, the difference is that what Donald Trump was wanting to do was to keep the income tax as is, and we're actually fundamentally doing away with the income tax and putting in this different cash flow system, one that actually Americans can understand. And as we continue to brief the Trump administration, they're slowly realizing that in fact this is probably the only way to do tax reform, because if you look at some of the proposals that were out there in the past, it's really tough not to drive a big hole in the deficit, which is I think what the anchor was saying just a few minutes ago. It's tough to get that rate below 25%. In fact, it's probably tough to get it below 30%.
Right.
So the only way to do it is through this fundamental reform that Chairman Brady has laid out for us.
Another option is to get the money, or at least to pay for part of this, if you're in that camp that says you have to pay for tax cuts, or you can use dynamic accounting and see what happens on the road, is that you'd have a border adjustment tax, something like that. Is that going to be part of this mix?
Yeah, absolutely, but it's not necessarily a pay-for. People are mischaracterizing that. So what this is, because we're going to a consumption system, it wouldn't be fair for us to tax businesses here in America, but not tax businesses that are overseas that are sending products into this country. So everyone's going to get taxed the same. Everything that we produce in this country, whether it's produced here or brought in, has to get charged the same tax. If not, you're subsidizing imports. And so it's just the way the system works. It's not necessarily a pay-for. So we are looking at dynamic scoring. This will be a pro-growth bill, and it will balance the budget.
How crucial is the role will play the incoming Treasury Secretary, assuming he's confirmed in the Senate today, because he has raised eyebrows by saying that the tax cut for the upper income, who would be subject to that 33% rate from 39.6% now, actually higher when you add in the Obamacare surcharges and the rest, that it would be offset by limiting their deductions, et cetera. Is it fair to say that the upper income then, despite what looks like a big drop in their tax rate, will end up paying roughly the same in taxes?
Well, it all depends on whether or not they want to invest. So if people are willing to make capital investments into the economy to create jobs and increase wage growth, then their tax rate will be lower. If you aren't going to make investments, then likely there won't be much of a trade-off. I think most people at the top will be about the same. But the goal of this reform,
you'd have to wipe out all their deductions then to address what would be a 6 or 7% aggregate drop in their rate, right?
Because unlike before, people can make investments into whether they're to grow their business. And as long as they're investing, they won't owe tax on that money. So today,
but I'm talking
if you
about
buy a piece of equipment,
in the marginal, the highest rate.
Right. So it depends on whether or not they're in business. So a lot of people will want to be in business. So we take all business activity and we move it to this new system.
Real quickly, sir, you're also on the Intelligence Committee. You're well aware of the controversy around National Security Advisor Michael Flynn. Do you think he should step down?
No, I don't. I have great confidence in Mike Flynn. He's probably the best intelligence officer of his generation. And you know, he's being attacked maliciously by the press, which is not uncommon in this town. And I think what General Flynn is realizing is that being a general is much different than being in politics, and he's just got to work his way through it. He's just now getting his team on board, and he's had an unprecedented leaks over the last few weeks, including leaks that have come from the conversations
but
that the President of the United States has had with.
As chairman of the committee, you don't think he should step down?
No, I do not.
Okay, I understand. All right, sir, thank you very, very much. We appreciate it.
Thanks, Neil. Thanks for having me.